than I thought I would be right now, because I am so glad I was not interrogated, I think I'd say, Stephen. So I'm glad I'm here by myself and not on a panel. Thank you for having me today. I'm going to endeavour to bring data to the party, so let's see how I go, and share with you a little bit what Danny said earlier on about this being a wonderful industry, and hopefully a predominantly positive message. So if I start with getting to grips with the global hotel landscape, and this is probably one of the most favourable parts of the world right now, but if we look at the globe in its entirety and look at supply, supply has started to slow ever so slightly. So supply is sitting at about 1.3% from a global standpoint. So broadly speaking, about 50 to 60% behind where it was about 2.5 years ago. Of course, we all know that's not quite the case here. More on that in just a few moments. As you know, once you build hotels, you of course want demand to follow, and demand is sitting at just over 1% globally. Now, something I didn't include today, but that I will share with you, is if you were to extract the global economies, the big powerhouse economies of the US and China out of this number, the demand actually would increase to about 2.6%. So slower performance in both the Chinese and the US economy right now. Looking around the world then, and looking at kind of the various different occupancies that we're seeing, pretty much everything with the exception of a couple of slides that I'm going to share with you today is year-to-date September. So you'll see Europe in the middle, kind of sitting around that 70% mark, roughly the same sitting in the Middle East, and of course things not standing still as new supply comes on board. And then the further you head over to North America, a little bit softer there. If you look at the US, that's more like kind of negative 3% year over year, so US by itself, so strip out the Canadian piece there. But a relatively positive view when you look around the world from an occupancy standpoint. Now, if we roll on and we look at the average rate, candidly, by this point in time, we did think average rate might have flattened a little bit more. Now, those of you that are glass half empty would say, well, 2% is pretty flat. But maybe we might have thought it would have been zero, or maybe even a tiny portion of decline if you're looking at Europe. Looking at the Middle East then, you're seeing about $169 year to date. So I'm going to drill down to the GCC and look at that in more detail in just a moment. The further east you go into places like China, the composition there more lent towards the economy and mid-scale market, so more mid-scale and economy hotels there, which is driving the lower average rate, sitting about $53 US. Looking at the globe in its entirety, though, and looking at the change, whether it's been driven by occupancy or average rate, it is still all about average rate. Average rate is the name of the game, as the caption says. A smattering at the beginning of the year or late last year of occupancy growth, but is still principally driven by the average rate performance. So let's look at the GCC. Does that equation add up? Does supply plus demand equal growth? Well, I think it's a resounding yes when we look at the performance. Now, I'm starting where I usually finish, and I will finish here also, but I'm starting with the forecast. So if you're looking on your far left-hand side, you're seeing how we're forecasting the 4 markets that we forecast for in partnership with our colleagues at Tourism Economics: Dubai, Abu Dhabi, Jeddah, and Riyadh. And I will, of course, split those out to show you what the contribution of each is in just a moment. A really strong starting point here on your far left-hand side, and expecting to tap out by year-end at about 8%. And again, majority of which is driven by average rate growth. A little bit softer into 2026, but still in positive territory. Some of that may shift and evolve as we see more events being announced as well. And then out into 27, 28, and 29, I think it's fair to say a very positive outlook for the GCC. So how do we get there? What do we use, and how do we get to those numbers as opposed to just seeing which way the wind is blowing? Well, if we start first of all with supply. So you've all seen, and many of you have been here for a number of years, you'll see supply has been a big talking point across the GCC. A couple of the peak years, 2017, about 22,500 rooms opened, and then 2022 is a little bit of an unfair comparison because, of course, some of that was the hangover from the global financial crisis, not global financial crisis, COVID, so you'll see that big peak as we went through 2022. The bars that you're seeing, though, at the bottom is year-to-date September. You'll see it's a reasonably kind of flat line as you go through year-to-date September. The trend line then, the full view for each of those respective years, with the exception, of course, of the last bucket that you're seeing there, which is year-to-date September. So less rooms have opened year-to-date September than in any of the previous years on this particular slide. Does that mean we're growing, though, or declining? Well, we're still very much in growth mode when it comes to supply across the GCC. It's just not as aggressive as it has been in the last several years. And we did even have some closures, temporary though they will have been, through 2020 as well. But still very, very strong growth in supply across. With supply then, of course, comes demand. So, of course, we want to see demand growing quite significantly. And there was mention both in the last panel and when Danny kicked things off this morning about the luxury side of things, the higher end asset classes. And you'll see this as that message certainly flows through when we talk about performance. So demand for the luxury segment in the GCC has never been stronger. Now, if you're wondering what's that mean in real terms, in real money, what composition does luxury make up across the GCC? It's about 32%. It's about 32% of all supply across the GCC is in that luxury segment. So it's a really, really robust asset class. The mid-scale and economy on the far right-hand side might be a question mark around what are we seeing there. A lot of that is actually repositioning of assets. So where assets have moved into maybe upper mid-scale or even upscale, a repositioning, rebranding, etc. So not necessarily closures, but growth across all asset classes. Now, if we look at the RevPAR, again, that follows suit when you're looking at the luxury side of things as well. So if we're looking at the RevPAR, though, for the various different countries on here, in some cases, it's entirely driven by average rate, as you'll see in the Kuwait piece on your far left-hand side. In some cases, it's a 50-50 contribution. But all key countries across the GCC are growing. Now, if we look at some of those individual cities, Saudi Arabia takes the top spot for at least 3 of those ADR locations. Now, when you look at Saudi Arabia, what's very interesting, this is year-to-date September. Let's see how we play out for the remaining 3 months. There is less than $3 different with the top 3 ADR locations in Saudi Arabia. So barely $3 separate each of those. Really robust occupancies, no matter where you are, across the GCC as well. So what are the key components? What's driving demand? We all know why we're here today, but what are some of the other reasons that guests and customers come to our hotels? So if I draw your attention back to, if you just look at Qatar for a moment, World Cup, huge driver of demand into the region at large, not just into Qatar. So you'll see the various occupancies, really, really strong tail end of 2024 when World Cup happened in Qatar. Average rate, it really pales in insignificance when you look at previous average rates, when you look at that really steep hook at the very far end of the series during World Cup. So certainly big sporting events, yes please, we would like many more of those coming into the region. If we look at then a Formula One, a fixture on the calendar for 4 different locations now for several years. Obviously you're missing Doha in 2024 having hosted the World Cups. There was no Formula One that year, but very, very similar occupancies. So again, want to see more of those kind of events coming into the region. And then average rate really depends on where you are in the world, or in the region, should I say. Abu Dhabi leading the way. And I think a huge part of the Abu Dhabi piece, really, let's be fair, some people don't actually go for the racing. They go for the entertainment that comes with it. So really, really successful. And another piece then, I thought about Taylor Swift, but she didn't come here. I think that was a mistake on her tour. But Coldplay certainly did. And boy, did they rock and roll in Abu Dhabi. So really significant, you'll see on the far right-hand side there. So drove an average rate of just shy of 1,000 dirhams. And that's just for one night of the 4-night series with Coldplay. I could have shown you many more, IDEX, I could have showed you GITEX, Arab Health. All of those are reasons to come into this region. There are, though, a lot of nuances in the region. So if we look at Dubai as one example of those nuances. Now, we've done something quite creative here, and I'd love to take credit for this, but this is certainly one of or many of our analytical team that have looked at this data. And we start over on your far left-hand side here, and we're looking at properties that opened pre-2000. So properties that were open and existing pre-2000. The different, I thought my eyesight was good enough to see that in there, so excuse me if I turn around. The next bucket then you're seeing that opened between 2000 and 2009, 2010 to 2014, 15 to 19, and then the last bucket is 20 to 2022. Now I'm going to put a positive spin on this and say this is what newer hotels have to look forward to. So when you're a little bit longer in the region, you're a little bit longer open, the numbers on your far left-hand side are the kind of average rates and RevPAR, fingers crossed, that you can look forward to in the future. So those established assets are certainly driving really healthy average rates and RevPARs. Dubai is an interesting comparison, though, when you compare it to Abu Dhabi. This does not mean that Dubai is declining average rate. Quite the opposite. It just means that Abu Dhabi is catching up. So if you look at year-to-date on a rolling 12 basis, there is less than 30 dirhams different year-to-date September on a 12-month rolling basis between the average rate in Dubai and the average rate in Abu Dhabi. So Abu Dhabi hoteliers are incredibly happy, and Dubai are looking for another way to break away. So let's see how that one plays out. So the competition is definitely heating up, and things are getting closer in more ways than one. If you look at Saudi Arabia, it is, of course, one of the fastest growing markets in the world. And we're looking right out into the future, both the historical supply growth, but wow, look at the far end of this chart and what we're expecting to happen well out into the next 5 to 6 years. So significant increase in supply, which will result in a minimum of doubling in a decade. And I think it's probably going to be a little bit more than that as well. Speaking about Saudi Arabia, despite the fact that Saudi has had this huge boost already in supply, it is still driving 4 of these 7 markets are driving average rates in excess of $200 US. So really, really strong performance. You know, working your way over here from the left, so whether it's Riyadh, whether it's Jeddah, Mecca or Medina, year-to-date September, and decent occupancies coming with those average rates. So what does the future hold? Well, the future, first of all, holds more supply, and quite a hefty amount of more supply. Now, these are the sensationalized numbers. I call this that I'm going to bring you down to earth in a moment, but there's 2.4 million rooms in pipeline globally today, right this minute. How many of those will come to fruition will remain to be seen, but that's what's in pipeline today, and every month we look at this and it evolves as we go through each individual month. Now, if we look at the Middle East as one such example, if all of that pipeline was to come to fruition, that would result in a 27% increase in pipeline in the Middle East alone. Now let me tell you what the real story is. The real story is that there are over 900,000 of those rooms that are physically under construction. So the likelihood of those rooms coming to fruition is incredibly high. The likelihood of them not is incredibly low. So we're going to definitely see an increase in rooms coming into the Middle East, Europe, North America, Asia Pacific, etc. So that's about 39% of that 2.4 million is under construction today. Where are those rooms entering? Well, I've touched on Saudi already. The vast majority are coming into the Saudi Arabia market, and another good chunk is coming into the UAE as well. And then a smattering, though, across the board. And the percentages that you're seeing on the top of the tower blocks, the growth projection if and when all of those rooms come into the marketplace. Now, if we look at the forecast and I told you I started with the GCC piece and forecast, and I'm going to end there as well. I'm just going to show you 2 different years. So you're looking at your far left-hand side here, again in partnership with our colleagues at Tourism Economics. So Dubai 2025, we think, is going to be almost a 50-50 contribution of occupancy and average rate growth. If we look at 2026, maybe a little bit softer, we'll do our next iteration of forecast the end of November. I think that might creep upwards ever so slightly. Abu Dhabi, though, is going to be definitely the star performer for 2025. And as you can see, pretty much entirely driven by average rate. Abu Dhabi 2026, I think, will depend on, again, more of those. We want more of the Chris Martins, we want more of those, maybe even we can encourage Taylor Swift to come back, more of those events coming into the market. And, of course, the corporate events. Now, before I show you Saudi Arabia, I'm going to heavily caveat Saudi Arabia and say this is very, very normal behavior for an aggressively growing market. So if we look on your far left-hand side, we're starting with Riyadh, and on your far right-hand side for Jeddah. This is not unusual to see when you have significant new supply coming into any market. It was a very similar performance that we'd have seen in Dubai, in Abu Dhabi, and in other global markets around the world when you open that many hotel rooms coming in. So that too will end up in positive territory in time. This, of course, then is just reflecting back to show you and remind you of that doubling in a decade of supply in Saudi. So with that, and I think I was 30 seconds over, thank you so much.